Hello friends, welcome to this July edition of Monthly Viewpoints. Global equity markets took a breather in June due to concerns of increasing inflation in the US, seemingly hawkish tilt by the US Fed, and the strengthening dollar. However, one-year returns continue to remain strong even after the COVID pandemic. US markets are at all-time highs, and India continues to be amongst the best performing markets. Globally, mobility and economic indicators are showing a strong recovery with both manufacturing and services firing. Strong demand recovery has led to higher commodity prices, which along with supply disruptions has contributed to the increasing inflation. However, rising inflation is seen to be transitory and central banks are expected to maintain an accommodative stance. Earnings estimates are being upgraded. Strong growth, loose monetary policy, and excess liquidity are boosting global equity markets to all-time highs. In India, the second COVID wave has peaked out. Pace of vaccinations is rising, which is positive for both consumer and business sentiment. Mobility and economic indicators are on an uptrend, and the impact of the second wave is less than feared. Monsoons are above normal thus far, which also bodes well for the rural economy. India now has increased linkages to global growth and fund flows. Consequently, exports are showing robust growth. India has seen a steady acceleration in FDI inflows, and the FX reserves are at an all-time high. In addition, fiscal policy remains pro-growth, and the mix of expenditure is skewed to capex. And the monetary policy would also remain accommodative till the economic recovery is secured. The reforms momentum has also picked up pace, which should lead to higher productivity. Especially, the PLI scheme should boost large-scale domestic manufacturing of goods to bring about import substitution and increase global market penetration. India is one of the few large economies to see favorable demographics, which gives us a competitive advantage. Overall, with all the key drivers in place, India's economy should now come back on track by FY23 to its trend growth of 6 to 7% per year. This should also lead to a turnaround in corporate profits. Now, as equity investors, one of the key questions for us is the growth in earnings. Now, globally, earnings estimates are being upgraded on the back of the strong economic recovery. In the past, recovery years which followed sharp earnings drawdowns saw very strong EPS growth. Importantly, consensus projections ended up being revised higher during these recovery years. Case in point is that in the US, the S&P 500 EPS growth for calendar year 21 has been upgraded to 35% per year versus 24% at the start of the last earnings season. In India also, the Q4 FY21 earnings have shown strong growth due to the low base. Impact of the second wave has been less than feared, and businesses are rebounding faster than in the first wave. The earnings may get impacted by a third wave, which is always a possibility, but its impact is expected to be much less than the earlier waves. The upgrade in earnings for commodity sectors such as metals and oil and gas is offsetting any downgrades in other sectors. The higher commodity prices could have a short-term impact on margins of some companies. However, overall, the FY22 earnings estimates for the Nifty have been upgraded from 35% to 40% over a year, mainly driven by commodities. Going forward, earnings should normalize with the Nifty earnings growth projected at 15% per year in FY23. One of the key investor concerns is regarding the currently high valuations. Now, globally, valuations are elevated due to the low interest rates and high liquidity. And even in India, headline valuations seem elevated currently due to the depressed earnings. However, from a medium-term perspective, valuations seem fair as the economy and earnings would have normalized by then. FII flows have been strong, and given the positive global backdrop with the second wave having peaked out in India, we can expect FII flows to continue in the second half of the year. Strong domestic flows and increased retail participation should also support markets. Finally, coming to our view on the market, for the medium to long term, our outlook for economic and earnings growth remains positive, and we remain constructive on equities. We maintain our view to play domestic cyclicals, industrials, IT, and financials. After the recent rally, the short-term upside may be limited, but any correction should also be temporary and minor. Investors should remain invested in equities, mainly through SIPs, and use any correction as an opportunity to increase equity exposure, as the risk-reward for equities is fairly balanced for the medium to long term. We offer a bouquet of funds for investors to choose from. Thank you and happy investing.